Welcome back to Real Estate Mindset. Today is going to be a very special live video. We're going to take some of your questions and we're going to give you guys some answers. And I have a very good person, great loan officer, great friend, Jennifer Rader, AMCAP Home Loans. Jennifer, how are
Hello,
you?
everyone. How are you today?
I'm good. I'm good. How are you?
I'm good.
I see
Fine
that
Saturday morning.
you don't sound sick this time. This will be our first podcast where you're not a little sick.
Yeah, I'm good.
I'm still fighting something, Jennifer. I just got back from blueberry picking, but let me kind of just tell the viewers kind of how we're going to do this, and then we'll go over to get their questions. But basically, we're going to have 4 segments on this video. At the end of each segment, we'll take your guys' questions, and the 4 segments are: number 1 is Jennifer's going to warn us about essentially just a few warnings about why it could be a problem using the builder's lender, what pitfalls on that. You guys may already know. The number 2 thing we're going to talk about is what impact school loans have on your debt to income ratio and your ability to qualify. School loans is a huge topic, so we'll figure out what impact that's going to have. Now, the second thing we're going to go over is if there's any credit restrictions. And I was telling Jennifer, Jennifer, we've been hearing from Jerome Powell, from a lot of these talking heads that it's okay. We don't have to rate hike. The lending, the credit restrictions are tightening. So we're going to get to the bottom of that, Jennifer, because that's a bunch of at least in residential. Residential is a bunch of nonsense. And then the last thing we're going to go over is why you should always get pre-qualified first before looking at a house. Now, obviously, Jennifer is independent, you guys. Last thing, Jennifer's independent. She knows how cautious I am. Okay, Jennifer knows how cautious I am. I told Jennifer before we even started this, when we hit play, Jennifer, you're on your own, and good luck out there. But we're definitely going to be honest and answer a lot of your questions. Let me say hi to everyone real quick, Jennifer. Look, we got Elijah. This is my dude, Elijah. We got Kim. I think Kim, you in Texas? You in Texas? Noel. Always appreciate you guys. Noel, always appreciate that love. Obviously, my boy Deuster. This is my boy right here. Melissa, good morning as well. So we're going to get this started. And I just wanted to say I appreciate everyone joining us. But Jennifer, can you tell us what could be the potential pitfalls of a buyer going straight to using their lender, the builder's lender, and why that can be a problem? And give us some stories about what's happened in your career as far as of one of your customers, you got fully pre-qualified. They dropped you per se because there was insane incentives to use the builder's lender.
Yep.
Something happened. They had to come back to you, things like that. Will you give us a little bit about how it works obtaining financing through a builder's lender?
Sure. So, and there's a couple different ways to look at it. When you're a buyer and you're out there looking with new homes and you go to see the sales reps and all those, the people who are there to sell the house, they're going to do everything they can to get you to buy the house. Number 1, obviously that's their job. Number 2, they're going to try to get you to use all of their people. So their mortgage company, their title company, they're everybody that they use because they want control over the transaction. So there's really no harm in that, right? They want control because they want it to close on time. They want to be able to know, okay, if the lender says this, it's really going to happen. We're really going to close on time. They're really approved, or, whatever the cases might be. So, I don't blame them for doing what they do because they want control, which is fine. However, what I would warn you guys about is that sometimes those deals are too good to be true. And the reason I say that is, and sometimes they're not too good to be true. So we'll talk about both. But when they're not too good to be true, or when they are too good to be true, is when they give you all these incentives and they're supposed to go towards either closing costs or buying the rate down or something like that. But at the same time, that lender is charging you much more than what a normal lender charges. And that's why we always, no matter whether we've already pre-qualified them or whether we've just started talking to them or they're just an inquiry, we always ask them to give us a copy of the estimate from the builder's lender, because we want to check for them and make sure that the fees they're being charged are normal fees. Are they, they have a, huge origination fee? We don't even charge an origination fee, those kinds of things. So we want to get copies of those estimates so that we can make sure that the buyer is really getting the deal they think they're getting and they know the truth. I just did have one the other day. This one we hadn't pre-qualified yet. He was just a phone call. He was just, his brother actually bought with us a couple months ago. Actually, it was one of your people, Travis, now that I think about it.
Oh, what?
It was, yep, someone
What'd you
from
get? Tell me.
I totally
What
forgot.
did you tell me, girl?
Well,
What?
the original loan was from you, and then the referral came from him. It was his brother.
Okay. Okay.
He was buying in San Antonio, and maybe he's on the show. I don't know.
Mm-hmm.
But anyway, he was buying in San Antonio from a
Mm-hmm.
builder, and he was upfront and told me he's buying from a builder. I said, okay, well, let's stop right there first, and have you gone to the lender? And he had. I said, well, send me the estimate. In his case, it was a good deal, but they were charging him a lot more than we would charge. But
Yeah.
because of the amount of the incentive, it still made sense for him to go there. And I said, look, here's what you're getting. They're charging this amount for the points for the rate. They're charging you this extra fee because they can, and they're charging you this. So here's your numbers of the cost, the extra cost you're paying, and here's what they're giving you. He thought he was getting, I think it was, I forget what the number was, like $15,000 towards closing or something like that.
Mm-hmm.
Well, after all the extra fees they were charging him, it was really only like 7 or 8. Still
Yeah.
significant, but not
Yeah.
15, right? So we want to do that math for them to make sure that they're still getting a good deal. And to your point earlier, there have been cases where we do that exercise and it doesn't make sense because the incentives are 8 and they're charging them 8 or 9 or 10. So they're actually charging them more, but it looks like they're getting
Yeah.
an incentive because they're getting credit at the end.
Yeah, I've seen like that twofold thing where, when I was actively doing origination, we would have customers, and we work hard for our customers. Unlike realtors, we don't have any type of buyer's rep agreement. And I also want to, in my opinion, and you don't have to say this, I'll say it for you, and you don't have to agree with me. I think loan officers work a lot harder than realtors and have a lot more to do. And I'm not saying that some realtors don't work hard. I'm just saying that loans are super hard sometimes because there's just so many different things. But in essence, you're essentially saying, and I try to show them this on my channel, Jennifer, that a lot of these new home builders are using data and like incentives to manipulate the entire market or subdivision, the localized market and subdivision, by in order to really understand whether or not you're getting a good deal, we need to do the research. We need to review the data. So I tell people, like, when it comes to the price of the house, do your market analysis. So when you walk in there, it's all numbers. And like what you're saying is a lot of these incentives that the builders are offering that require you, that force you to use their lender, a lot of times those lenders are charging $8,000, $9,000 more than a normal loan. So it's washed. But what they do is they give, they basically eliminate the representation for a good loan officer like you. They put them with whoever is there at the time, and they take total control. I don't like the total control. I think, honestly, by not having total control in certain situations, we can hold each other more accountable in certain situations.
I agree.
Now, I'll also argue that I'm so disgusted with this industry, Jennifer, that I'll just take total control myself and just do everything myself, including the blame. You know how everyone like points the finger like, oh, I didn't do that, it was your fault? Dude, a lot of times I'll go in those arguments and say, it was my fault. Let's move on now. Is everyone?
Yep.
I'm alive. I just say I'm still alive, but it's crazy. But the other thing is, the talk about basically the experience. Usually, what I'm saying is typically I've noticed there's not as skilled loan officers. Generally, not as skilled loan officers that are working directly for the lenders.
Mm-hmm.
Is that something that you've noticed, or have you noticed that the customers that you do lose to new home builders, or do you think that they're like solid loan officers, or do you think they're geeks, for lack of better words?
I think it's kind of a mixed bag, actually, because I've had some, like you said before, I've had some that left and then they came back because their experience was just going so terribly. And I think that's all to do with the experience and the knowledge and everything of the loan officer. I think the other part of that is that just like some banks, and I hate to use money, but they make a lot less because they have to for them, it's just transaction, just get them in, get them out, get them in, get them out. It's not like that with us. We want to make sure that that client has a great experience so that way they'll refer more people to us because that's how we earn our business. These loan officers are earning their business because they're attached to a builder. So and I don't want to say it's easy business because nothing's easy these days, but it is much easier because they're handed these leads and they're handed these loans where we have to earn everything. So I feel like for that reason, a lot of their experiences are not the same because they don't get the time taken that they might need throughout the whole process. They don't get in their hand held, which they might want. Realize, and may not even realize they want or need it, but then realize, oh my gosh, they're in the middle of this and they really need some help, and the help's not there because that person's on to the next buyer. So, I think it is a mixed bag.
And also what we're, it is, guys. And also what we're saying is like, as loan officers, when a builder offers an incentive of like $20,000, $30,000, they remove our ability to compete.
Yeah.
And then likewise with the realtors, a lot of times they will like not pay a realtor if the realtor didn't come in with them on the property. I've had so many trolls argue like, no, why should they pay them? Well, I would say, well, they should pay them so that the consumer has good representation.
Yeah,
But like
I totally agree.
these builders are nuts. So you don't have to say, but some of them are nuts. So okay,
Yeah.
I'm just going to say that straight up.
But
Now,
let me add
yeah,
to that real
yeah,
quick though,
yeah.
Travis, as a buyer. So this is, gosh, probably 15 years ago now. I actually bought my first house in Texas was from a builder. And I mean, yes, and I was even in the mortgage industry at the time, right? Kind of new to the, well, not new. I guess I was in it a few years, but not so much here in Texas. I had just moved here. So at any rate, we went looking, and of course, we didn't look with a realtor. We looked on our own, thinking, oh, we can do
Mm-hmm,
this all by ourselves.
mm-hmm,
We bought from the
mm-hmm,
builder. We didn't
mm-hmm.
even do a home inspection on a new house because that time, actually, it's probably like 19 years ago, actually. I was like, why would I need a home inspection? It's a brand new home.
Mm-hmm.
And that's terrible too,
I
and I
know.
no representation. I just paid what the builder asked. I didn't negotiate. I didn't ask for extras. I didn't do anything like that.
Mm-hmm,
And of
mm-hmm.
course, in hindsight, a couple years later, I was like, oh my gosh, why did I not have someone on my side negotiating for me? Because I definitely didn't do it by myself. I just
I'm
paid
t-
what they wanted. And people don't realize that you should have a realtor when you go for a new build because you want negotiation. You want to make sure that you have all these referrals to inspectors and stuff and make sure the property is what you want too. So, that's my take on that.
And honestly, and that's why I'm really like screaming at and like trying to sound the alarm here. People are like, oh, why are you picking on the new home builders? I'm like, well, you guys need to understand. Like, you don't understand until you have to understand because you're in the situation sometimes.
Mm-hmm.
So, I just did an interview probably 2 weeks ago from a homeowners that had no representation, no inspection, and ended up getting a lemon house. We just got the mold report back yesterday. So there's mold all up in the house, right? Mold all up in the house. And then she said the same thing. She's like, it was a new house. We didn't think we needed an inspection, and we trusted
Yeah.
the builder. And I'm trying to tell people like, no, you guys, like they have so much control. They have a monopoly on the situation. So here's a question, Jennifer. So this is Melissa. I've been trying to tell my viewers, get your license, get your realtor license, because I think that they should. I think the more data that we have, the better decisions that we can make. And having access to live MLS data, active data, is it's so important to paint the picture of like what's going on in a local market. So I'm always like, y'all. And not only that, we can use our commission as a down payment. So there's a lot of advantages. One of the advantages, though, is not the dues. The dues are brutal. But anyways, here's Melissa. She's asking how I'll be able to navigate buying from a builder representing myself as an agent. I'd be a new agent thrown to the wolves. That's exactly how this works.
Mm-hmm.
Like, people don't realize that's exactly what happens when you get licensed. You are thrown to the wolves. What should I look for in the contract? Sneaky fees, etc. You want to go ahead and start with that? I have a very passionate,
Sure.
charismatic.
I'll start with that.
Yeah.
My answer is probably a lot shorter than yours is. What I would say is, number one, obviously you're learning how to be an agent. So do your research, know what you're doing, do as much as, shadow someone if you can. Pick a real estate agency that is going to help train you with things like this. But I would say number one thing, whether you're representing yourself or not, read the contract. And I know that sounds silly because a lot of people think, well, of course I'm going to read the contract. Well, builder contracts are like 30 pages long. There's a lot of information in there. There's a lot of data in there. Sometimes it references specific fees. Sometimes it just says something in general. So I would make sure you read that contract from start to finish in depth, make sure you're understanding, and then ask that builder questions in that contract and say, hey, well, this is saying, whatever, you're paying my title policy, but are you paying my title policy no matter what lender I use? Or are you paying my title policy only for this? Or, ask a lot of questions.
Yes.
And that contract is so important.
So solid. It's so solid that you said that, Jennifer, because I found several contracts where it specifically says, if you don't do this, you don't get this. And
Correct.
I'm telling you,
Yep.
I'll tell every single person right now, working with builders is not a normal negotiation process. They will say no. They will say, no, I have a buyer lined up. If you don't do this, we're just going to sell the house right from underneath you. All right, real quick. Noelle, I appreciate the love, you guys. You don't have to do that. Buy someone behind you some coffee. Show some love to some people, you guys. I want you guys' heart to be good. I really appreciate that. I have one thing for Melissa real quick, and then I'm going to take a look at this question. But for Melissa, Melissa, I'm gonna be real, Melissa. You are the number one runner up I've ever met. I feel so bad. We have a first place comment champion type thing going, and Melissa's always number two, like by only 1 second. It's like her and Dave. I love them. But Melissa, what I would suggest, okay, well, I can't give personalized financial advice, but if it was me, and I actually am licensed, but I'm gonna take my broker. Because in order to be licensed, you have to work under a broker. I'm going to take my broker into the transaction with me and make sure I'm doing everything correctly because my broker will have more experienced eyes on contracts and new builds and things like that. So, although, yes, you are going to be thrown to the wolves, that's 100%, but I'm bringing my broker to make sure that I'm doing what I'm supposed to be doing. So that's what I would say, Melissa. And just to put in perspective, Melissa, if she would get, say she was at 100% commission, if she buys a $300,000 house, that's not typically you get 3 points. That's $9,000, Melissa. That's $9,000 that you would make, and you can use that $9,000 as your down payment. Just saying, it's pretty cool stuff. I have another question here. I don't know if you feel like this is you can answer this, but how bad of an idea is it to get a bridge loan until your property sell and then pay it off with cash?
I don't think a bridge loan's a bad idea at all, as long as you're secure that the house is going to sell in a reasonable amount of time. So that way you're not stuck with two mortgage payments for a certain amount of time. So I don't think there's any harm in that.
But is there a bit of risk in it if the home doesn't sell?
Oh, sure. Yeah. Because now you're stuck with two mortgages, right?
Yeah.
So yeah, I'd say that the risk is that if you don't think it's going to sell or sell quickly, or, you don't want to put yourself in even if it's a short-term financial bind, you don't want to do that. So I think that would be the risk. The other thing to think about too is, do you really want to pay the house off in cash and not have a mortgage? I mean, that's really something a financial person should help you with, a financial advisor, because a lot of times it makes sense to keep a mortgage. I know it sounds crazy. Why should I pay something with the rate when I could pay cash? Use all that cash to invest in something else that makes a lot more money than what you're paying on the house. So I'm not a huge proponent of paying cash for things, because you can invest that money and make so much more than what you're paying on the house.
I'm right there with you, especially now if credit tightening happens. Cash. The whole cash is king is coming back fiercely. I'm trying to tell people, look at this comment right here. Tell me what you think. Kind of from the outside, Jennifer doesn't listen to all my videos. She's too busy working on her own stuff. And then your kids and like all the sports games. Like I told my wife, like if our kids all have softball, like I don't think I can handle it like that. That wreaks havoc on parents. I want my kids to go to like survival school, jujitsu, like knife throwing. You know what I mean? Like that type of stuff, like how credit works, how to make a resume. Anyways, so what do you think about this? There needs to be a special YouTube that it's the Crash Bros versus the cheerleaders. Do you know what that means?
No, I don't.
So I would love to do this so much. I want to do this so badly. The problem is, so basically like the Crash Bros, it's like me, like warning people to be cautious, warning people of, impending additional price declines. And things like
I
that.
gotcha. Yeah.
And the cheerleaders are like the toxic realtors that are just buy. Values only go up and up and up. And so there's this whole dynamic on YouTube. But I would absolutely love that. I think it would be really entertaining. And actually, it could make both parties pretty sharp. The problem is you don't know who's just making noise and who actually has enough expertise to talk. I'll tell you, one of the guys I really like that I would love to talk about that we have opposing opinions is someone named Millennial Mike. I met him by chance, and he's this really cool dude that's like he's a SWAT guy. So anyway, it doesn't matter. But I would absolutely, I would find that I think a lot of people would enjoy that quite honestly. And I would as well. But again, it's like, I know they like the drama, Jennifer, but I don't like being a part of the drama. It stresses me. Okay. So here's a comment. I don't understand how loan officers like Jennifer are paid if they don't charge an origination fee. So I'll answer that real quick. After the Dodd-Frank Wall Street Reform Act, this is crazy, but most loan officers are treated as W-2 employees now. So we got our whole industry turned upside down back in 2010, 2009. And by the way, there's a class action lawsuit right now with the National Association of Realtors, by the way, for billions of dollars. I don't know if you knew that. So there's probably going to be a change of realtor commission, which I think should happen. You don't have to comment on that. But basically, we get a minimum wage salary. Generally, full-time loan officers get a minimum wage salary, and they don't make no money if they're not closing. Very stressful job. But that's kind of how that works. Oh, let me real quick. I'm not sure. Steve Daria is a part of our YouTube channel. I'm sorry, our YouTube chat group, but I don't know. I haven't talked to him in a little bit after the hurricane. I really love Steve. Really good guy. Let me see if there's any questions real quick and we'll move on. Preserve 15 where it seems a lot bigger. Person cover zone. Good. All right. So I don't see any more questions. I don't think I missed y'all's questions, did I? Did I talk about the bridge zone? Talk about the bridge zone. Okay, guys, throw up some questions if you have some more. Let's go into the next thing. So, in conclusion, be warned, you guys. Be warned about builders. All right, that's really what we're trying to say. Now, let's talk about school loans. Hold on 1 second. Yeah. Okay. So real quick, talking about Melissa. So yes, it is income, Melissa. So although so if it's $9,000, you'll be taxed on that. But I would rather still have the $9,000. You know what I'm talking about? Like just take 25% of the $9,000 and put it in a checking account, and you still got $6,500. But yes, it does tax you, and I know that because I got blindsided one year. I was like, oh, I completely forgot I used that for down payment because I was like, whoa, what is this 1099? I wasn't prepared for that. So yeah, be careful, Melissa. But it is a great way to move in for a little out of your pocket. You know, if you're a realtor, anyways. All right, now school loans. Okay. Can you talk to us, Jennifer, about, and I would like to talk about collections as well, because collections are so, there's so many misconceptions about how collections work on your credit report and how collections will impact your lending. But we'll start with school loans. Now, a little background on school loans, y'all. The amount of debt in school loans exceeds credit card debt. The amount of debt in school loans also exceeds auto debt. The only debt, in fact, higher in with consumers is mortgage debt. So school loans is a huge thing. When you have school loans, that debt impacts your loan and your qualification. So Jennifer, will you kind of take us through how school loans work versus various loans? And do you want me to pull up this chart?
You can. Yep, you can.
Okay.
So the summary is that even if a school loan is in deferment or whatever category you might be in, we still count the debt in your debt to income ratio. So it's going to affect you no matter what. Mm-hmm. And it's going to affect you differently depending on what kind of loan. So these charts are showing you each different category of loan and how we calculate the amount of debt we're going to count for you. So if you have, and actually I have a lady right now, she has $70,000 in a student loan right now. And on her credit report, it shows 0 for the payment.
Right.
Well, pretty much everybody's student loans right now show 0 for payment because of what they're doing, right? Everything is kind of on hold. Well, if it's, and there's a couple different levels here. So if it's truly a 0, like she actually has say an income-based payment plan set up, and the payment due is actually a $0 amount or a $10 amount or 50, whatever it is. Sometimes it's not reporting on the credit report. So we have to get paperwork from the student loan company to show what the payment is.
Yes.
So on your chart there, you can see on Fannie, if there is an actual payment set up, we can use the actual payment as their debt.
Okay. Yes. Okay.
Yep.
Do you still need the payment schedule from the school loan company to verify the payment on the credit report matches?
Yes, we do. Yep.
Okay.
We have to verify that. Now, if it is like most people right now where there's just no payment listed at all and there is no payment agreement set up, we have to count different percentages depending on what loan type. So you'll see, and I have it next to me here too. On Fannie Mae, it's 1%. So she has $70,000 in loans. I have to count $700 a month for a monthly payment for her. Right? Is that 5%?
Yes.
You did not. Right. No, that's 10%. 350. 350 is 5%. Yeah. 0.5%. Sorry. 0.5%. I'm so confused right now, Travis. I just totally lost my train of thought.
No. Well, that's on the Freddie. You're talking about Fannie. So Freddie is a half.
Freddie is 1%. Yes. I went to Freddie in my head. Yes.
You so like 1%. How I knew that right there? You impressed or what? I've been out of origination. I still knew that. So we're talking. Let me recap real quick. So basically, guys, what we all need to understand, like this is Jennifer and I's language, and I absolutely love talking about loan stuff. I'll get to you, Melissa. But there's basically 2 banks. It's Fannie Mae and Freddie Mac. There ain't no banks outside of Fannie Mae and Freddie Mac when it comes to mortgage, in my opinion, because they're so big and they make all of the rules. So Fannie Mae has, we can go Jenny as well, and then Gus. But for the sake of argument, it's Fannie Mae and Freddie Mac. Fannie Mae does their own thing. Freddie Mac does their own thing, but they have slightly different guidelines. It makes things really hard. So what she's talking about right now is DU, Desktop Underwriter Fannie Mae. If a school loan payment shows zero on your credit report, like almost everyone's, what you have to do is you still, as a loan officer, have to come up with a 1% payment to be calculated against your debt to income ratio. So if you have $100,000 in school loans, 1% payment is $1,000. And that's what she means. Now, what she got twisted, and I do this all the time too. That's why it's like, I have you here, Jennifer, because I can't keep up. What she's got stuck on is what's called LP, Loan Prospector, or Freddie Mac. It's crazy, Jennifer, that Freddie Mac allows, instead of doing 1%, you only have to do 0.5%. Is that what this says?
That is correct. That is correct. Okay. So when we have someone who comes through and we know they have student loans, and especially if they're heavy duty student loan numbers, we're going to run them through Fannie Mae and Freddie Mac, because they may not qualify if we use the Fannie Mae number. They may only qualify if we use the 0.5% with Freddie Mac.
Yeah.
So we're going to run them through both systems to make sure that we can use the lower number to make sure that they qualify.
Okay. I just had an epiphany. Y'all, listen to me. This is why I preach to so many people. Having good pros matters so much. Having a good LO that understands how to get people to where they need to be, and give them a loan at the least amount of cost possible.
Right.
It's priceless. It's priceless. I mean, who understands this crap, Jennifer? Like me and you breathe this. I love this stuff. So I'm sorry, I didn't mean that. But basically what she's saying, if someone can't get approved through DU or Fannie Mae, she can flip you over to Freddie Mac. And if you have a whole bunch of school loans, she can reduce the payments that's required on those loans. And that allows us to get a lower debt to income ratio. Is that right?
That is correct. And that means they can afford more.
Okay. All right. Do you want me to pull up do you want to go over this last thing, or should I pull up the VA and the other one?
The next one is FHA, which is similar to Freddie. They used to be a full percent too. FHA, no matter what the case.
Oh, direct.
Yeah.
FHA direct. Okay.
Yeah. If we go FHA, it used to be that even if there was a payment on the credit report, we were not allowed to use that unless it was more than 1%. We could only calculate a full 1%. Well, they've now changed that to 0.5%. So very similar to Freddie. So it's nice we only count 0.5% now instead of a full.
Okay, here's where I made a mistake. So it wasn't really a mistake, but basically the first two we were talking about was conventional Fannie Mae and Freddie Mac, correct?
Correct.
And now, okay, I was thinking that it was FHA, Fannie Mae, and Freddie Mac. But okay, so the first two was conventional, because we can run FHA. You know what I mean, through Fannie and Freddie. But FHA calculates 0.5% on the loan balance as well.
Correct.
Is that right?
Yes.
Okay.
And that is regardless of what the credit report says.
Okay. So no matter what the credit report says, FHA automatic 0.5% of the loan balance is your payment.
Yes.
What if I get a deferral from the loan company, from the student loan company? Is there any way doing an FHA mortgage that I do not have to count school loans against the debt to income ratio?
No.
Okay.
Actually, they changed it recently. Let me make sure.
They changed it so much, man. Like the MCC?
Yes. Actually, yes.
I didn't know
I forgot they did change it. If you look at the very bottom part of the chart, and I forgot about this, Travis, this was not too long ago. So let's back up for a second. It used to be full 1% no matter what the credit report said.
Right.
Then they changed to 0.5% no matter what the credit report said. Or if there was a payment on the report, we had to use the higher of the two. Now we can change it to the actual documented payment. But again, everybody's showing zero right now. So there is no documented payment on the credit report. So if that person does have a payment schedule set up, it should be on the credit report, right? So if it's not, we're going to assume there's not a payment plan set up. But if there is one set up, then they just send us the documentation showing what it is, and then we can use that number.
I love it. I got the VA and USDA up. Let me go to a couple of these questions real quick. Now, I got a little bit wrong what Melissa was asking. She was basically asking if she should waive her commission instead of having that commission as a seller credit to avoid taxes.
Oh.
No, Melissa, you should not waive your commission. I'm just going to tell you you should definitely not waive your commission. You should make your money and pay your taxes, because they're just going to keep the money anyways. Like, they already have it worked into behind the scenes through MLS, how much the realtor is going to get paid. So if you waive that, you're not going to be, you're done. What you want to do is you work on the deal, you negotiate. After you've negotiated, then you can go back and say, what if I waive my 9 grand of commission? I want that off the purchase price. But never ever do that in advance. You never show them all of your cards. And I did that with Eric. I waived my commission to get him that house, but I never told anyone I was going to waive my commission, so that everyone would fight it out. And then when they reached a standstill, I came in like a superhero, like, boom, I'm waiving half of my commission. Suckers, we're getting my client the house of their dreams. So it is the wolf. It's a bunch of wolves out there. It's a bunch of wolves out there.
That's a great negotiation tool. You know,
Huh?
I think that's a great negotiation tool.
Okay, so we got lots of inventory. I hope that answers you, Melissa. This is Terry has me laughing. This is funny. I love you guys. All right. Let's see here. If student loans are resumed, is it going to restrict? Okay, take a look at this. This is a good question. Okay, because we did answer this, but this is a little bit confusing. So their question, Jennifer, is like, when the actual payments resume, is that going to restrict buyers? But before you answer that, in the sense of a lending guidelines, will it affect buyers? You and I know that it's going to affect buyers because they're going to have to pay more money out of their pocket.
Yeah.
So it's going to put strain on households. It will put strain on households. That will impact people's purchasing power. But from a lending perspective, what do you think there?
I think from a lending perspective, it's probably going to help, actually. And the reason I say that is because I would imagine that most payment plans that are set up with student loans, those monthly payments are probably going to be less than that 1% or less than that 0.5% we have to count. So we'll actually be doing a favor to the buyers when they're under a payment plan, because we're going to count less in their debt, which means they can afford more. So I think it's probably going to help. Now, there's probably some outliers where their payments are actually going to be more than what we're counting, and that it's going to hurt them for that reason. Mm-hmm. But I would say the vast majority of payments are probably going to be less than that 1% or the 0.5% we have to count.
And we don't work for school loan companies, but we've worked with them before. Mm-hmm. It's the payments are income based. Is that correct?
I think for the most part, they're income based. But I know there's also very specific income-based plans where not all student loans are that way. So I think it depends on the loan. I think it depends on who holds the loan. I think it depends on, there's subsidized and unsubsidized. There's a lot of different categories. So I think it really depends. But there are very specific income-based plans that someone can get under, which are the best because, like I said, it's going to be less than the 1% or less than the 0.5%.
Yeah. So basically, in other words, Elijah, the reality is it is going to hurt people because it's an additional expense. That's a reality. But from a loan perspective, like just a loan guideline perspective, in certain ways it can actually help, right? And in certain ways it could actually hurt people. So good stuff, Jennifer. So I have this up here whenever you're ready. VA and USDA.
VA is my favorite. Because VA, if we can get documentation from the student loan company that they're in deferment for at least the next 12 months after closing date. So like, let's say we've got someone under contract right now, they're closing in July. As long as their payments are not due before July of 24, we don't have to count anything. We can count a big fat zero, which is awesome.
That's insane.
Yeah, VA is my favorite.
Insane. What if you can't?
They're common sense. In my opinion, they don't have to pay it for a while, and hopefully by then they're making more money and they can make their payments. So that's my favorite. And then they have this. I hate doing the calculation for them, but if it's not deferred and it's just zero like everybody else's, then we have to do this 0.5% or 5% divide by 12 and stuff, which comes out almost to about 0.5% anyway in most cases. So
I see that. I honestly love VA as well. VA is my favorite loan. By far.
Mine too.
And honestly, I love the fact that they use residual income instead of DTI. I think residual incomes is so smart because DTI is based on gross income. Yep. If we took the actual income, Jennifer, that people are taking home, if we took net income, people's DTIs is like 60, 70%.
Yes, it would be. Yes.
Oh my God. Yeah. Like people don't realize they're using gross income. It's not real. So the DTI is a lot. Anyways, I won't go there. Okay, so just to recap on VA, basically, if you can get a letter or some type of documents from the servicer, you can actually have and it's a zero payment, then you can use the zero payment for the loan.
If it's
right?
deferred for the 12 months, yes.
For if as long as it's deferred for, so yeah, right. We'll have to have something in writing. It's deferred for 12 months. But if not, VA has a very interesting calculation. You take 5% of the outstanding loan balance divided by 12.
Yep.
Interesting.
I know.
So,
It's very strange.
so yeah, so it's about 0.5%.
Yeah,
So in
it
other
still
words,
comes out to
guys,
about 0.5%. It's
so
weird.
like the rule of thumb is it's going to be about 0.5% payment of your school loan balances being used against your debt to income ratio.
Correct.
All right, what else we got here? I have USDA. Oh, here's
Oh,
a
yes.
question before
No, go ahead.
USDA. This is a question to you. I'm starting to get jealous. Y'all, where's my question? But no, you're the guest. I'm just kidding. I'm very. Thank you for showing her respect to everyone. I really appreciate that. Any guest on my channel, I always show love. And I've taken people that do not like me on my channel, Jennifer, and I had to stop doing that because people were getting upset at me. They're like, Travis, why would you do that? They're just getting clout. They're just getting views. But I was like, I thought I was doing the right thing. I wanted to give people perspective. But some of these guys are wackos. Anyways, I'm one of them. I'm a wacko, but okay. Good question. And I know it's situation pending, but to the best of your ability, can you answer this question? How do you look at income-based repayment plan provided by the U.S. Student Loan Department? I'm assuming you should take the payment. How long is that payment good for?
Yeah. So if kind of the same as some of the other requirements we just talked about, if we can show that there is an actual payment agreement in place, it doesn't matter whether it's income based or whatever. We don't care how they came to the number, as long as there is actual documentation from the student loan company saying what the payment's going to be. So depending on the loan, we just went over the rules. So it depends on the loan on how we're going to count that. But say for Fannie Freddie, if we have an income-based plan with an actual number, they'll allow us to count that number versus the calculations that we have. So I hope that answers your question. I think that's what you were asking.
Okay, here's a follow-up question for her. This is tricky. Okay, so they're on a fixed income. Okay, they're on Social Security income. So our adjusted gross on tax returns is 0%. The reason that is, guys, is because generally Social Security income is tax-free. So because it's tax-free, it will show a 0 on the tax returns. Can you confirm that with me, Jennifer?
Yes.
Okay. What would you require our document if using the income-based repayment plan? So what documentation is needed to show the payment plan from the school loans?
So we just need documentation from the student loan company. So like, let's say Sallie Mae. Let's say you have a loan with Sallie Mae and you're on the income-based plan. We just need documents from them showing what your payment is. That's all we need. I think maybe what you're asking is, what do they need in order to come up with your payment? I don't know the answer to that question. That's something you need to ask them.
Yeah.
Because even though your adjusted gross is 0, you are making money. It's just tax-free. So I don't know how they calculate that kind of stuff. But for loan purposes, we just need to know what they're requiring you to pay. And that's the document we're going to get from that student loan company.
Yeah, I think you're right. I think she was asking how they calculate it. And I'm not,
I don't know.
I think there may have been one time I used to know that, but I'm not 100% sure now.
Yeah.
So hopefully we answered that. Last question before we get back into USDA. This is regarding the LLPAs for the Biden good credit tax, whatever we want to call it. It has taken effect. And I believe it took effect May 1st, if I'm not mistaken.
It actually, so I actually can't believe you don't know this, Travis.
Yeah, tell me, did it go away?
Ever. It originally took place. Well, it was about to take place. And all of the investors had started making all their adjustments already because we had loans in process and the dates.
I had the chart.
They actually put it off until August.
Oh my gosh, I did not know that.
August. Yes.
I didn't know that. My bad. Oh my God. That's what Kim, don't hate me, Kim. I can't know everything, Kim. There's so much changes, Kim. So much change. I'm worried about my children. I'm worried about my wife. I'm worried about where I'm going to live. I didn't know. All right. So the LLPA adjustments for having good credit have not taken effect. They pushed that down to August 1st. Right. Is that right?
Yes. But I haven't heard anything since that to know what's happened since then. So I don't know where it is currently.
Okay.
Personally, I think there's going to be so much pushback that it's just never going to happen. But that's just my opinion.
This is a question I want to get back to. This is so powerful. I did a video today about the new, you guys listen to me real quick. There's a new 100% FHA program. Listen to me, viewers, anyone that's viewing me. This video is going to be put out this evening. All right, I said, Jennifer, let's not talk about it now because this video is going to be put out this evening. There is a new 100% financing, zero down FHA mortgage where they give you back and forgive 3.5%. They're paying you. Anyway, we'll get to that in a minute. We'll get to that a little later. I don't know why his question brought that out of me, but okay. So commercial lending. What do you think about this? So Jennifer, she's in the hot seat. Jennifer is about consumers, helping consumers, figuring things out, putting a puzzle together. She doesn't have the ability like I do to like surf the web and like navigate all this data, even though I was wrong about the LLPA adjustments. My bad. So you may not know this, but I'm curious, Jennifer, what do you think about this question on the screen? Can you see it?
I can see it, and I honestly don't know. In what month should the majority of commercial real estate defaults and bankruptcies? That's a really tough question for me. That's a Travis question. I don't do a whole lot with commercial, so that's a Travis question.
You guys, just all I'm going to say, Robert, listen to my video this evening. I talk specifically about how I believe we're actually going to get inventory, not lose. We're going to get inventory from institutional investors. Because here's the thing, you guys. If an institutional investor can buy an office building at like 40 cents on the dollar and the lending restrictions have tightened up, which it has in commercial, where are they going to get the money from to buy that great deal? Some of them are going to sell their assets like SFRs, portfolios, things of that nature to accumulate enough money to purchase. Anyways, just watch the video tonight. I don't want to spoil anything. I'm so sorry. Please talk, Jennifer, about USDA. I'm so sorry.
Honestly, I don't do a whole lot of USDA. And the reason I don't, I think we talked about this maybe on one of our other chats, is that so many people don't qualify for it because the way USDA calculates income, they count more income than we actually need to for the loan. So I honestly don't do a whole lot of USDA, but you can see right there on the chart, they have their own, and I'll pull it back up over here. They have their own way of calculating it too, whether it's in forgiveness or what stage it's at. So they've got their own rules. So if I were to do a USDA, which I would love to do a USDA loan, but if I were to do one, I would just look up the guidelines here. Looks like deferred, we don't have to count anything. And same thing, 0.5% outstanding loan balance. So very similar to the others. They just word it differently for whatever reason.
Yeah, it seems like it's a 0.5 point across the spectrum, except for conventional DU or Fannie Mae loans.
Yep, and deferred on VA. VA. Remember, we can count 0 for that. So
right. Yeah.
Okay, it gets really confusing. Even us, we do this every day, right? We deal with students every day, and I still, you saw before, I just completely confused myself because I'm like, wait, no, there's so many different levels of rules. It's like, okay, what am I doing right now? I don't even know.
Like people don't get it. That's what I need someone here. Like this stuff is so important. And real quick, look at what Kim. She is in Houston. Call Jennifer, Kim. Not now. Well, Jennifer, you didn't hear that. When you're ready, Kim. Which hopefully it's not right now. Well, hopefully you're ready, but you're just anyway. I'll shut up. I know, Kim. I know you weren't calling me. I was calling myself out, Kim. I was calling myself out. Okay, I was ashamed of myself. I don't want to say anything wrong. And what I've learned, Jennifer, like with doing YouTube videos and stuff, and like all these great people, the core subscribers you're seeing here. I mean, just absolutely dazzling people, just lovely people, but. There's another category, percentages of viewers are like their hate views. It's the craziest thing. Yeah. And anyways, I don't know where I was going with that. People say that I have ADD. Do you think I have ADD, Jennifer?
You really want me to answer that?
Yeah, but I want an answer that I want to hear though.
I'm not going to give you an answer.
Just buy now and refinance later. All right.
Yes, I think you do, but I think it's because there's so much going on in your head with all of these different things that we research and you're talking about. I think, you just kind of go off in different places, but
yeah, I know.
But anyway, just to your point about, the trolls and stuff, I'm a firm believer in if you have nothing nice to say, just don't say anything. Yes, you have an opinion. You have an opinion. We all have an opinion, right? But why do you have to get into a negative, mean discussion about something? There's just no point. Put your opinion out there, but put it out there nicely. You don't have to be mean about it. So that's just my opinion.
Well, I won't be mean to you, Jennifer. Um, I was mean to. I did a live yesterday. I was really mean to someone. Like I got home. I was just. I know. I probably shouldn't have done that. I told Orlando. I'm so sorry. But
Oh,
I got
no.
home from work. I was so excited, or I was so exhausted, and I was just feeling raw and spicy. And that's dangerous sometimes on video when you're feeling raw and spicy. At least when I'm
Oh,
feeling
no.
raw and spicy. So I got on raw and spicy and did a live. And I was like, you guys, I don't have time to edit. I'm gonna do this live. And
Oh,
y'all,
no.
I had massive ADD on that one. I'm gonna be
Uh-oh.
real. Maybe you guys saw that. Okay, here's the question right here, and then we're gonna get to the next thing, which is credit restriction. Here's a good one. I think I didn't read it. Travis, should we wait to buy a home and rent in our new city, and then sell our current home as our market is good right now? New home city has no inventory and bidding wars on good homes. What to do? So let's just say that she's going to be moving from Austin to San Diego. Okay. San Diego has like very little inventory. Most of the inventory is new construction. This is a hard one, Jennifer. You already know that I'm going to be super cautious and I'm very bearish
Yeah.
for many reasons. But what do you say when you, and I know you're not a realtor. Okay. And I know you want to stay in your lane, but I'm going to swerve and make you get out of your lane or you're
Okay.
going to crash. Okay. But what do you think here? I mean, I'm interested to hear what you have to say.
So I always kind of approach these questions with a mortgage mind, but also as a personal mind, right? What would I do? So what I would really say is I do like the idea of renting when you go somewhere new, and for many reasons. But the first reason is, unless you know the area really well, if you go and rent, especially if you can get a short term, like a 6 or 7 month rental or something like that, that allows you the time to go around and see where do you really want to live? Where are there even houses for sale, especially if you're going somewhere that doesn't have inventory? So I think renting is a great idea for that reason. And you get a layout of what is it going to cost me, to move to wherever you're going. I think the second thing I would say is, in terms of selling the house or not selling the house, I would find out first. One, are you comfortable keeping your existing house and then renting somewhere else, or keeping your existing house and buying something new? But find out if you can afford to do that on paper, because if you have a good rate on the loan you already have, you maybe don't have the urgency to have to sell it right away again, unless you
Mhm.
need the money for the purchase and stuff. Obviously there's reasons for that, but if you could keep it, if it's got a good rate, you can keep it as a rental property, use that to make yourself some money while you're renting, or even while you buy in the new place, if you can afford it and are comfortable doing that. You may be able to afford it on paper, but you're like, heck no, I'm not going to have two mortgages. I don't want to do that. That's too risky. But think about that too. I wouldn't tie your sale specifically to the move or anything like that. I would evaluate all the other financial parts of it first, and then decide when the right time to sell that house is.
You make me start crying. That was really good.
That's a good
I never,
answer.
I don't know what you're gonna say. That's why I was like, you're on your own. I don't know what you're gonna say. Yeah, I'll just say this, and I have to be very careful, how I say this. But let's just get the disclosure out of the way real quick. It's gonna really depend on your personal goals, your financing situation, what you want to do in your future,
Right.
and we don't know those things. Knowing those things would really help us to kind of figure out what to do. But just to generalize, I'm just going to generalize. Like I'm going to act like if it was me, I'm in Austin, I'm going to move to San Diego, right? Just hypothetically. If it's me, well, you guys already know what I did. I converted my primary residence to a rental, and then I rented myself. Part of the reason is I kind of had to, like, I wasn't planning on doing it so quickly because I didn't want to wait out the housing market by renting, but I was kind of forced to like do that ahead a little bit because of situation with neighbors. Okay, so I jumped the gun a little bit, but here's the thing: I do not want to sell my. I don't ever want to sell my houses. All right, I only have one. I have a note on another house that's almost paid, but I only have one house, and I don't think anyone should sell their house. But there are times like what we're in right now that I believe that we're in like a massive bubble, and I would consider selling my house, Jennifer, if values this year, and I don't think they are. It's like everyone's waiting to the very last second before they smash us down again. The rates are going to go up. I know that's scary. I'm so sorry. I don't want to scare you, but the thing is, it's a 2.3. I will sell my house if home values go higher than they were last year. I'm gonna sell my house. I'm gonna cash in. because I understand like how much money that is in equity. I will sell my house and I preach against it. I have a 2.3 right now. I'm making $900 a month net. So it's a solid investment, but it's like, I understand how overvalued my house is. And if someone's going to want the house at a 7.5%, 8% interest rate, well, by all means, here it is. Let me cash in. And what I would do with that cash is I would continue to sit on the sideline. Now, if I had to move to another city, I will cash out. Okay, it depends. So, because it would be hard to property manage a property in another state. But it's just so hard. I mean, on one hand, you would get a whole bunch of money, but like I really don't need that money, and I like the asset, and I can always sell it 20 years from now, and it probably will be double, right? I have tax benefits. I think what we're going to see is people more than normal convert their primary to a rental. So whether you convert it to a rental or whether you cash in, I'm not going to just blindly go into a market and buy. I'm gonna have a lot of due diligence done. I'm gonna have my market analysis done, so that I know what I'm walking into. And I love what you said, Jennifer. I think like at the very least a short term rental so that they get their bearings,
Yeah.
right? Like
Yep.
make sure your job's good. Make sure you have enough time in the area to look at crime and noise and things like that. But and that reminds me of a viewer, a really good guy. His name is Medic. I don't know if he's online or if he'll listen to this, but Medic, I was worried about him. He cashed out in California, right? I was like, "Yeesh." I was like, heck yeah, man. And he's like, dude, I'm moving to Idaho now, right? And Idaho is an amazing place. But I was like, are you gonna rent or own? And he was like, I'm gonna own. But what I should have asked is like when. So I'm worried about like him, like my boy Medic, because now he has all this money now, like a whole bunch of money he got from Cali. And now he's just. I hope he doesn't just go to Idaho and just buy something, right?
Yeah.
I love what you said about like, and not everyone's going to do that, Jennifer. We know that,
Hmm.
right?
Yep.
Anything that you want to add there? I was a little bit rambly.
No, I'm good.
Okay. All right. Good question. Otherwise, okay. Let's see. Do. Let's see here. Okay, I think we answered your question pretty good.
Oh, you're welcome. Thank you for that. And thanks for the questions. I love the questions.
Okay, take a look at this. Okay, take a look at Robert. All right, Robert, this is a good point. So these are the points that are being made out there, Jennifer. Okay, so renting your house is interesting. Okay, but and he has a point. You could park that cash from selling. I can't believe I didn't say this, Robert. Oh my God! Like, how did I not? Because that's what I'm also doing. Okay, selling from the proceeds from selling and get a 5% without the trouble of being a landlord. Okay,
Mhm.
and case in point, we bought a block. I think the bid or the auction was on Monday, I think. But Jennifer, on a 1 month, okay, and I buy in bulk of 1 month, I got 5.88%.
Wow. Wow.
So I'm trying to tell people like, you want to know what's helping me offset the inflation? I'm
Mhm.
putting my liquidity in like high yield savings account, so I get a few $100s, and that helps offsets the eggs that I have to pay for. But I don't even care about the eggs. I want less prices on houses. But great point, Robert. I'm ashamed that I didn't say that. That's absolutely right. And that's what a subscriber I have. His name is Jeff M. And Jeff, I really love this guy, Jennifer, because I really see like the reason I like this guy so much is like I wish that's where I was at when I was his age.
Mhm.
The amount of self-control and discipline, and this is not, it's phenomenal. So that's what he's doing. Instead of like, I got to buy a house because he has enough money he's saved to buy it all cash. Instead of that, he's just getting paid 5% off a whole bunch of money.
Right. Right.
So it's not
Which
the
is a great idea, which is what we were
yeah.
talking about before. Instead of paying cash for your house, use your money to your advantage and invest in whatever, what treasury or whatever it is you want to do. Make money on your money. Don't pay cash for stuff. Keep that cash making money somewhere else for you. So Robert, yes, I love this. I think it's a great.
Dave Ramsey would disagree with you.
I know he would.
I'm doing a video today about Dave Ramsey. He's got the Glenn Ross leads. Let's be real. But I wanted to show everyone real quick because I got a couple comments, and then we're going to go back to you, Jennifer.
Okay.
But this is where I buy my treasuries, just in case anyone was wondering. I go to Treasury Direct. So I log in here, and I go to auctions. I bid on Treasury bills, and I automatically renew it. So basically it's just all set up for me. I don't even have to do anything. So this is where I go, guys. People are asking that. Now, if you want to know how to invest in treasuries, just look it up on YouTube. There's really good videos, and that's how I found out. I just educate myself on YouTube, and you guys could do the same thing. But I go to Treasury Direct, and I wanted to, just answer that question. So where are we now? Oh, Jennifer, let me set you up for this next thing. Let me just make sure there's no more questions. And their point is, we could park our money, get 5-6% interest rate, but you may not even get that much cap or profit back from owning a house. So then it becomes more speculation at that point.
Right.
All right, let's see here. So if you make, oh yeah, okay, yeah, Robert, okay, yeah. Okay, do you know this question? How long can a bridge loan be for?
I actually don't know that. Here in Texas, we don't technically have bridge loans. Years ago, when I was in a different state, I think they were 6-month terms, but that was a long time ago. So I don't know the answer to that question.
Okay. All right, here's a good one. Really, really, really cool guy as well. Don't move to Texas. I shouldn't bring this up.
Texas.
I shouldn't bring this up, man. But I moved to Texas, brother. I'm so sorry. I feel so bad. But you know what? I married a native, so I was bred into being a native, and I've been here decades. So don't hate, okay? And I'm from SoCal. It's even worse. So you know what I mean? Like, you're from SoCal. Get out of here, Travis. I'm sorry, guys. I don't like SoCal, man. I just wanted a normal life. Okay. What's the average DTI ceiling you're seeing for conventional VA, FHA, and new see, we're getting to the tightening here in a minute. So the next question is tightening and lending. Have you seen that metrics move at all? And me and her talked about that. But first, tell him about the DTI for conventional VA, FHA, maximum.
All right, cool. So this is a loaded question because it's not a simple answer, actually.
True.
So conventional is simple because conventional will, in most cases, there are exceptions to this, but in most cases, you're capped at 50% DTI. There are some cases you're capped at 45. There are some cases you're capped at 43, but in general, 50 is the max on conventional. VA, which we talked about before, Travis, is our favorite loan. There is no DTI cap, technically. VA goes off of your residual income, which is a different calculation than your DTI. I have just recently closed a VA guy. His DTI was ridiculously high, like 65%, but he made the residual income requirements, and he was putting, he had very strong file other than that. So VA, there's really no answer to that, right? We run it through the system, we do the residual income, and then we find out whether we can do it or not. So there isn't technically a cap. FHA, I don't know that there's an actual real number cap because FHA, just like our other systems, look at all the strengths of the file and all the weaknesses of the file, and all of that together is what determines their level of risk, which determines how high they'll let us go on the DTI. But I will tell you in general, the highest I've probably seen on a DTI recently on FHA is probably a 56, 57 maybe. So still relatively high, if you ask my opinion. I don't think DTIs that high should be buying a house, but if the system lets them, and there's reasons sometimes we only have one spouse's income being counted, for credit reasons or some other reasons. So there's a lot of times there's other factors involved, even though the DTI on paper shows very high, there could be other compensating factors.
All right.
So that's my answer for that.
I love it. All right. Tell me how my answer is still okay. So conventional, if you're barely qualifying, max 45%. If you're well qualified conventional, max 50%. VA max I've seen is a little over 60. They don't use debt to income ratio, but they still kind of do. FHA maximum debt to income ratio, depending on compensating factors, is 56.99% of gross income. That's what I'm trying to tell people. Like, this is gross income, guys. This is not even net income. So when we add like take home, that's why I like residual income, like what VA does. When we add when we take the taxes out of the income, these DTIs are like 60-70%, which is like basically what I try to warn people, Jennifer, is like there's 70% of Americans living paycheck to paycheck right now. If any of those, and some of them are homeowners, some of them are renters, but if anyone of those people has a disruption of income, they're never going to be able to catch up again. They have no money. They're living paycheck to paycheck. Just one loss of income or disruption is crippling to people. And that's really sad. When I found out it was 70%, I'm like, man, because those people have children. And anyways, so Elijah has a good point. There's no capital gains tax on your primary residence. Interesting thing is there's a new IRS law. Actually, there is, I think, a cap of 500, 300 or 500. Anyways, I'm going to do a video on it. The IRS has just loosened the tax laws on capital gains for your house.
Nice.
They're they're trying to think of everything except raising interest rates. But anyways, I think let's move on to credit tightening. Now, let me tee you up a little bit. Let me put some stars here. Actually, I do have a couple more questions, but I want to keep it moving. Refinancing from a VA. Okay, that's a good one. Reserve. I'm gonna get you reserve currency. I like that question. You guys have some really good questions this morning. You guys give us some really. What's up, Jason? I got my homie right here, my boy Jason. What's up, homie? I'm gonna go walk a property with him. He's in Katy. He's in
Oh,
Katy by
cool.
where you live. Yeah, by your area.
Yeah.
So tell us now. Here's the thing, Jennifer. Here's why this question is so important. We have been told by I don't know how many economists. We've been told by Jerome Powell right after he met with Congress, saying we're going to have rates higher. We're going to have rates longer, which we're seeing now because of runaway inflation, specifically in the housing market sector. But they've been saying we may not have to raise rates. Maybe everything's okay because naturally the industry is going to credit tighten. And although there has for sure been credit tightening in the commercial sphere, can you tell us, Jennifer, have you seen like hardcore guideline change restrictions? Can you tell us about any potential restrictions you're seeing or anticipate incoming?
We honestly really haven't had any. And I hate to give a blanket statement like that, but in general, I would say, the approvals we've been getting and the approvals we've had, people who are looking for months, they're still approved. We haven't seen any tightening in terms of the residential side with someone who maybe qualified yesterday, but they don't today. So nothing, vast or strict or anything like that. I'm sure there's a lot of subtle changes that have probably been happening through our systems, but nothing that I've seen that would just all of a sudden say, yeah, this person doesn't qualify anymore. So I haven't really seen much of that. Whether it's coming or not, that's a really hard question to answer.
Yeah, I mean, I'm so glad you're here. So it's like someone else telling them, but yeah, where's this magical credit tightening? I don't see no. I think that if they tighten credit up a little bit, then maybe we don't need to bankrupt the economy by having high interest rates. Anyone think of that? But it is what it is. There's you guys. The thing is, I will argue, Jennifer, that I have to be so careful. I don't want to get you in trouble. I know you have to be super neutral. Where I'm just like, I'm letting it all hang out, man.
Yep.
Like that's where I'm at with my career. I'm just letting it all hang out. I'm just gonna send it. But I lost my train of thought. Where was I at? I'm so sorry. Your hair was blowing. I was thinking, is there a fan? See, I have ADD. I saw that at the bottom and it
There's
threw
an
me off.
AC right there.
Oh my God, I'm ashamed of myself.
That's funny. That was for sure. We were talking about credit tightening.
Oh yeah.
I don't know where you're going with it.
I will make the argument that credit's loosening.
Mm.
I'm gonna, and this is why now, not across the board, but I'll make the argument in certain situations credit's loosening. We didn't, at least that I know of, we didn't. Maybe correct me if I'm wrong, but I don't think we had that 100% financing FHA mortgage where they're paying you back 3.5%. Did they? When? Do you know when that came? When did that come out?
I know we just learned about it about 2 weeks ago. So I'm not sure how long it's been around, but it's been available to us for about 2 weeks.
See,
So
to me, they're actually trying desperately to loosen credit, Jennifer, because they want more market share. These lenders are making less money. Because they're making less money, they got to get more creative. And honestly, I see the fact that they are making less money, they're actually trying to push a little bit harder on the like more of a risky loan, But for the sake of argument, there's really nothing that we've seen definitive so far, and there's thousands and probably tens of thousands of guidelines, but just up front, right? So let's start with Kim, and then I want to get to reserve currency. You guys throw some more questions up here. We're starting to get to the end of this. This is from Kim. Is interest on a cash account? Oh, okay. This is good. This is good, Jennifer. Is the interest that you're making on your savings account, can that be used towards your home purchase? But not the money. Okay. The money, as long as it's sourced and seasoned, you can use that, Kim. But my question to Jennifer is can we use that as income?
No. We can only, and there's a lot of restrictions on income. We could have a whole hour session just on income because income can get very complicated. But no, we don't count that as an income. But Travis is right. We can count it as assets, right? It's part of your money and it's in your bank account. So yes, it can count towards your down payment, things like that. But counting as an income, that's no.
Okay. Thank you. Thank you. I have a San Diego here. So I'm from SoCal, brother. I was just in San Diego. I'm from SoCal. I love California. Okay. So as far as California, Jennifer, it's beautiful. They have the ocean, the desert, the mountains. It is and it's always 70 degrees. How is it always 70 degrees?
That's the best place.
It's so great, but there's no way in heck that I would ever want to move my family back there and raise them. It's just everyone. It's just a dog eat dog world out there. It's just I was married to my house payment, and I didn't really understand how rude people were. And I have to be careful. Not all people, but some people overall in California. I never knew how rude they were until I got to Texas, and I realized how rude I was. I was like, oh my God, I didn't, I had to like correct myself. I'm like, wow, there's so many nice people. Like I was misunderstanding people's generosity because I was so used to people being disrespectful. Right. So I don't know why I'm saying that. I've been to San Diego. I love it. It's so expensive. There's kind of crummy people there. All right. What are the good? I want you to think deep. I want you to think deep. First glance, I'm like, there's no advantage. Okay. His question is, what are the pros and cons of refinancing from a VA to a conventional? And let's say, Jennifer, that let's just say the rate is lower. Okay. Right now it's not. It's really hard to refinance right now. But I have my answer. What are the pros and cons of refinancing from a VA to conventional?
The biggest one that I can think of would be if someone is paying a VA funding fee because they don't have any level of disability or anything through VA, so they're paying the actual fee. And on a refinance, going from a VA to a VA, the refinance fee for the funding fee is like 3.3%. So it's pretty significant in terms of dollars. So that's probably the one I can think of right off the top of my head is that you'd get rid of the funding fee by going to a conventional loan.
Okay, that's what you got?
That's what I got.
Okay, here's mine. All right.
Cheers.
Okay, so I'm just going to say so first of all, I can't really think of any, like at first glance, I'm like, there's really no reason why you would want to, for that reason alone, go from VA to conventional.
Yeah.
Because refinancing is not all it's cracked up to be. You have to start the whole amortization schedule again, so you start from the beginning. But there is one thing. If I was living in my primary residence and I had a VA loan and I wanted to do a cash out, or I wanted to make sure that my VA eligibility was renewed, right? Then I might refinance my primary residence into a conventional mortgage as a primary residence, then convert it to a rental property, right? Because my conventional is now more favorable.
Yeah.
And then I'll buy my next primary residence with a VA mortgage. I mean, I'm digging deep. All right.
Yeah, no, that's a real good one, especially for the cash out. I thought of that and then didn't, but yes, if you're going to pull cash out for sure, you'd have to go conventional.
Yeah, because can we get cash out on VA or all? It's rate and term only?
Rate and term only. Yep.
Yeah.
Interest rate reduction is basically all you can do on a VA. So yeah, if you're going to put money out or convert it to an investment, yes, I think that's a great thing.
But really that's, there's really another reason why you would want to, maybe there's like off the cuff reasons, but y'all don't want to just refinance. It could be a bad thing. It could be a good thing. But right now it's just when rates keep going up, you're going to refinance into a higher rate. And I think the market share right now is like 20% cash out refinance, Jennifer. What does that tell you?
Yeah. Not many people are doing cash outs at the moment because so many people have good rates. They don't want to touch their rates, touch their mortgage at all.
Right.
I just thought of something in regards to that, and not to bring a bad subject into it, but financing from a VA to a conventional could actually be a requirement at some point due to divorce and things like that.
Oh.
So if you have, let's say you and your, I forget the gentleman's name, but, say him and his wife had a VA loan and they're getting divorced. They want to each go buy their own homes. Or let's say he's keeping the house and she's going to go buy her own house, or whatever the case is. VA is only allowed to be the borrowers on a VA are only allowed to be a veteran and their spouse, or a veteran and another veteran, or a veteran and a person who has survivor benefits of a spouse that was a veteran. So if something's changing in their marital status, then they may have to get out of the VA loan and go to conventional to get that other person off. So very way, way to the side, but that is a situation where you would have to do that.
And I'm not sure. So I'm not sure. I see there's like a little bit of back and forth conversation. I'm not sure what if he's talking about the Treasury thing or refinancing from VA to conventional. But Sandblast, if you're there, give us a little bit more detail. And I didn't scroll up, so I'm not sure what the conversation is. But let us know how we can clear up anything there. So here's a good one. What do you think about it? So this is my boy right here. He's saying he might want to use his VA loan as an investment property. What do you have to say to that?
Well, if it's an existing loan, then you can leave it the way it is, but you cannot buy a house with a VA loan on investment property. VA is only for primary. So if you're talking about keeping your house, loan as it is and just turning it to investment, you can do that. But you are going to be using up some of your eligibility, so you couldn't buy another house with it. Well, you could, but there's a worksheet of calculations we have to do to see if you still have eligibility to use a VA loan again.
Right. So in other words, brother, you cannot purchase. Okay, you cannot purchase a home as an investment property, but you can always convert it later on. What's the livable requirement? How long do you have to live there before you can do that?
Oh, that's a good question.
I don't.
I knew that at some point, but I don't know if I remember.
Me too. I can't remember either.
I know you have to move in within 60 days.
I know that.
Yep. And I want to say it's a year too. That's kind of where I was going, but I'm not 100% sure if that's still true anymore. So for now, we think it's about a year.
Okay, good. Oh, there's a Texas Land Board question. All right, so here's an interesting question here. If you sell your house and move to another state, I don't think that matters if you move to another state. How long can you keep the profit until you have to pay taxes? Use that. So let me just say this. I got this one. There's something called, first of all, if it's your primary, well, okay, time out. I don't want to get in trouble. Talk to your CPA. I'm not a CPA. Talk to yours. But in my situation, if I apply this to it, the only time restraint that from having real estate proceeds as far as being taxed and not taxed is something through a 1031 exchange. And I can't remember what the time frame is in a 1031. I haven't used one myself, but I think it was either 6 months to a year on the 1031. I'm not 100% sure, but if it's your primary, and again, talk to a CPA, I don't think there is a time frame. I think the only time frame exists when you're doing a 1031, and that is taxable proceeds. And I know you're not a CPA. Do you want to add anything to that?
I think you're right. And I had a buyer doing a 1031 a couple years ago, and I think it was 6 months for her because she was stressing out big time with the dates that we had to get closed by. I think it was 6 months, but I'm not 100% sure either. But yes, I think you're right. I think it depends on, if it's taxable income because it's an investment property or whatever. So, but yeah, I'd say, and those laws are very complicated in my opinion too. So for sure, get a CPA that knows what they're doing and have them make sure that you're not going to have any implications by selling it and holding it.
Okay, this wasn't a question. Okay, but what he said here, TVLB is the Texas Veterans Land Board. I'm not sure who he's saying that to. Okay, let's see if we got any more questions real quick. VA, it's 100% legal. I'm not sure. They're going back and forth with Sandblast. I'm just not sure. Okay, here's a good one. Depending on the loan officer, you're going to get a different answer here. So please take this one away.
All right.
How long? Yeah, sorry. How long is your pre-qual good for?
Our pre-approvals are good for 4 months because the credit report is valid for 4 months. So we collect all your documents up front, we do the credit report, and we have a 4-month time frame. Now, it doesn't mean that we won't extend it, right? So if you get to the 4-month period, you haven't found your house or closed on it yet, maybe you're under contract but haven't closed yet, we just pull a fresh credit report, update your documents, and we just keep it going. So it's not like everything ends at that point. We have to start over completely new. We just extend it with updating whatever we have to update, including the new credit report after the 4-month time frame.
You're so nice. Like, that was a good answer. I scare people.
Oh, do you?
Oh my God, yeah. I take I'm on the exact opposite side of the coin. I tell people your pre-approval is good for 1 day.
Yeah.
If anything changes, I know that's right. I know that's why I'm on the other. Yeah. And technically, you're right as well. You guys, the reality is a pre-approval is like good for 1 day, but it is so valuable to get it because it really is a microscope on your financial situation, and you have a licensed professional like Jennifer analyzing everything, and you can actually put a plan together. But the reality is, if anything changes, you get a car, you're late on something, your pre-approval's done.
Very
It's
true.
done.
Very true.
But
Yep.
if nothing changes,
Yeah.
then technically it's good for 4 months, because I say 2 months because I say 60 days to close, and we don't want to. You see what I'm going with that?
Yep.
See, I'm on the other side. but technically it's good for 4 months, because that's how long your credit report is good for. And lenders don't just keep running credit reports. They try to go off of the original credit report and the credit refresh at the end, making sure you're not in any additional debt. Is that right?
Yep. You've got it. And that's why we have a big list of do's and don'ts, because we don't want anything to change. Don't change your job. Don't quit. I've had someone quit their job and not tell me. I mean, gosh, that'd be another hour too. But their financial picture changed, or they did go out and buy a car, or my 1031 exchange lady didn't tell me she was buying another property at the same time, of all things. Are you kidding? You're doing a mortgage with me and you didn't tell me you're buying another property too in another state. So, I mean, there's all kinds of things that could change, but yes, you're totally right. I should have qualified that. If nothing changes, you're valid for 4 months.
Yeah. No, we're just iron sharpens iron. That's all. You know what I mean? So I'm not 100%. This is from Sean and Wendy. Sean, Wendy, love you guys. They actually won, I believe, I actually did 2 gift card challenges. Sean and Wendy, great people, very supportive. Does, I know we stick in residential lending. Last time I heard there was broker outlets for certain commercial financing.
Yes.
Does AMCAP do commercial financing?
Yes. So if we have any kind of commercial interest, we send them over to Russell, and he'll figure out what we can do with that. So I wouldn't say that we are like 100% can do any kind of commercial lending, but we do have outlets for it, depending on what it is. So yes.
All right. Okay. I see I'm way back on these comments. I thought it was to the bottom, and it just like popped up a whole bunch of stuff.
Really?
Let me just, yeah. TNT's from San Diego, but moved away because too crowded and expensive. Exactly, girl. I wanted a family. I wanted children. I wanted a wife, these things. And I couldn't do Cali anymore. Appreciate you, TNT. Let's see here. Oh, okay, Jason. Oh, Jason, I thought you already owned. Jason? So Jason doesn't own. He's a VA buyer. He's in Katy. Jason, love you, brother. Thank you for your support, man. And also, let me just say this real quick, brother. In my opinion, you're doing the right thing. You're not alone, man. Don't feel forced. Take your time. All right? You're not alone. And a lot of other people are with us on that. Let's see here.
Thank you for your service, Jason.
What do you say?
I said thank you for his service, being that he's a veteran.
Yeah. So TNT moved to Oregon. I love Oregon. Well, the landscape, right? The politics just make me sad. Is there a chance that the banks? Okay, take a look at this. Take a look at this. All right, I got something for her here. Oh, I got House Hacker. Oh, I'm glad House. I don't know. I'm so far up on the comments. I hope House Hacker's still here. I want to talk to you, House Hacker. Stay online. All right, and I appreciate your story, House Hacker. Oh, you know what? House Hacker's different than Rev Nation. I keep forgetting. One of them is like super easy to talk to. The other one is like super hard and abrasive to talk. I can't remember which one. I think it's Rev Nation, but stick around, House Hacker, because Rev Nation also purchased in San Diego, and I want to talk about it. Now, this is what consumers are asking, Jennifer. Is there a chance that banks will call these low interest rate loans? Aren't the banks losing money with these super low interest rates? I won't go into the $400 billion bailout, but I want to.
So I'm going to take the second question first. And my opinion is that, yes, they're losing money because the rates are so darn low, right? But that's not their entire portfolio. They have other kinds of loans. They have other mortgages. They have all kinds of other things making them money. But yes, I don't know if they're losing money on those loans, but they're certainly not making much, if anything. So I think the short answer to that question is yes. The first question you have, they can't. You may have a different opinion, Travis, but they can't call a loan due just because they want to, right? Just because it's a low rate. There has to be a reason why a bank or a lender would call a loan due. So they can't just all of a sudden say, well, I don't want to keep this loan anymore. They have an agreement, and it's a legal agreement with you to keep, have that mortgage for 30 years or whatever time frame you picked for that low rate. So they can't just out of the blue say, call it due. unless something materially, happened that you're not paying or something like that.
100% agreed. Let me tell you where this is a problem. There has been this like whole cult like following about doing as is financing, or I think it's called as if, is basically cutting the corners of doing an assumable mortgage. So,
Oh,
so they're buying a property. They're taking the good financing from the current owner, saying, "Don't worry, I'll pay this. Here's some money. Leave me alone." All right. So they're not. A lot of people are not going through the proper channels to do assumable mortgages, and and I keep telling people, like, it's all fun and games until the lender calls the loan, because you are not allowed to do that.
yeah,
There, in every mortgage, pretty much QM mortgage, qualified mortgage, there's clauses, acceleration clauses, that if anything changes on that loan, they'll call it immediately. If it's title, if it's new ownership, you can't just give your good 2%, 3% loan to someone.
right.
There's a huge process for that. So a lot of investors, Jennifer, like during 2022, were really big on that. And I was trying to warn people, like, you guys, if rates go up, these lenders are going to call these loans because they're losing money on you.
Yeah.
So that's a situation that
But only if they violate something they're not supposed to violate. They can't just out of the blue say,
right.
not doing
Yes.
it anymore. So,
Yeah. They can't just out of the post. So it's funny. So again, Rev Nation, House Hacker. I'm not sure. I appreciate everyone's savviness. You see what I'm saying? The
yeah.
problem is there's just so many people yelling, and like the thing is, this House Hacker, like, dude, I want to talk about this. This is a success story in a very difficult market, but don't think the entire market's like this. You know what I mean? Like, the dude found one house. There's hundreds of thousands of houses and hundreds of metros. You can't be going around like, yeah, like, we get it, brother. Like, you got a good house. Like, hurrah, hurrah. Like, dude, that is awesome, though. I'm not gonna act
But
like
you
that's
did get
not
it at a
awesome.
good rate. So that's awesome.
He did. He did.
Yeah.
So take a look at what he did now in San Diego. Now, San Diego has year-over-year price decline, okay? But it's as a result of, like, it's so overvalued, and those prices are staying a little, up there, I believe, because there's like almost no inventory. San Diego's
Wow.
hurting. I
Really?
just got there, but I found so much new construction. I got so much hate. The realtor's like, no, resale. I was going for new construction. Like, back off, people, and kick rocks, creeps. Now, this dude right here, smart. I love it. And I think I want to bring this up, guys, to all my viewers, because, and this is what I'm saying, I believe that even though this is our primary residence, we're all, including myself, looking for our primary residence. Real estate is a dog-eat-dog world. Real estate is it can be one of the best things or one of the worst things you can do, like what happened with me. In my opinion, first-time home buyers should be treating the purchase of their home like investors. So by all means, we can talk trash and be frustrated at investors and institutional investors, but nevertheless, you guys, they have very savvy ways of purchasing real estate to assure them they're getting a great deal. And here's someone right here that was able to do that. According to his story, obviously we haven't verified any of this, but I'm taking him at his word. This is a person that was able to do that in a very tight, tricky market. And what I'm saying is y'all should do the same thing. When we go in emotional and blind, that's when we can become victims. But when we have savvy, like, let me read this comment. I haven't even read the comment, but this is what he says. Looking at our current San Diego inventory interest rate, I am so glad I brought my second property late August. So he purchased in late August of 2022 with an interest rate of 4.375. Not only rate is low, my mortgage is covered by 2 tenants. So, but my point here is we can't truly talk with absolute certainty. You see what I mean? Because even in a really hard market like San Diego, this dude, again, face value, he found something that it appears, based on what he's saying, is a great deal. So really, Jennifer, what I'm trying to say here is use the data to find the deal. Okay?
Yeah, I agree.
That's all.
I agree. And every part of the country is different.
Oh, here we go. Okay, so someone wrote this up here. So 1031 is 45 days to identify the property, but it's saying you have 180 days to close. I really appreciate that. Thank you for chiming in, brother. Still talk to a CPA. None of us are CPAs here, but that's a good indication of what to expect, I hope. Okay, let's see here. All right, so I'm gonna look for some. You guys throw some more questions. Oh my gosh, they just loaded here. Okay, so here's all the questions. So as I'm looking at these questions, will you talk to us about pre-qualification, Jennifer? What is pre-qualification?
Okay. Pre-qualification is when someone comes to us, they fill out a loan application, and we can do everything electronically. If you want to, most people do. But we pull their credit. You guys set in your financials. So we start out with pay stubs, W-2s, bank statements, just as the basics. And then if we need more, we ask for more. But we start with those. And what a pre-qualification or pre-approval does is it gives you really three things that you need for buying that house. Okay. The first thing is the credit check. And credit check is so important. I talked to 3 people yesterday. Friday was the day of people who had issues in the past and want to fix them. Do you know how good your credit is? Do you know how bad your credit is? Do you know what's on your credit? Most people don't. Most people are not even checking their credit. You're allowed to check it for free every year, and most people don't check it. So credit check is number one, right? We're going to look at the credit. We're going to see where the scores are. We're going to see what the content is. We're going to see, is there anything on that credit report that could prevent you from buying a house? Just because you have a good score doesn't mean you can buy a house. Just because you have a low score doesn't mean you can't buy a house. It depends on what's making up the negative credit or the good credit. So credit check is the first thing that we're going to do on the pre-approval. And that's the first thing you guys as buyers need to know. Where do I stand? Right. And if we know where you stand, we can figure out where to go if you're not ready to buy in terms of the credit.
Okay.
The second thing is going to be, we're going to check your income. We talked about this before, right? You might think you make whatever, $100,000 a year, but can we count all that 100,000? We don't know yet until we know what kind of job you have. How are you paid hourly? Are you paid salary? Are you overtime? Are you commission? Do you get a per diem? We have a lot of people in our area who work at plants and they get per diems for the work that they do. Can it be counted? Well, it can in some cases and may not in others. So it just depends. So income is the second things we're going to check on, because your income obviously directly affects how much you can afford, right? On paper, what we can count. You might be making 100, but we might only count 80. And does that allow you to qualify for the house you want? Right. So that's number 2. And then the third thing that you're going to get in a pre-approval, and the third thing you need in a pre-approval, is what's my house payment going to be and how much money do I have to bring to closing? Those are 2 really important figures and really important numbers to know. And if you don't get qualified ahead of time, you don't know what those numbers are, and you could be looking in the wrong price range when you go to look for that house.
I love it.
In a nutshell, those are the 3 things that a pre-approval is going to give to you, and the 3 things you need to know, in my opinion, to even start looking at a house or start
100%.
looking to buy a house.
Yeah, some of the 2 most important things is, like, when I look at a house, I want to know before I step in the house, how much is it going to cost me a month and
Yep.
how much out of my pocket. I wanted just to pull this up real quick. I love this. Me and House Hacker, I think that we were off. I don't remember. I try not to take comments personally, but I take them personally. Not necessarily the troll comments, but like when people are like struggling or like really have constructive stuff. And I think House Hacker and I like got off on the wrong foot. And I think it's because a lot of people, Jennifer, are assuming I'm just saying everything is going to crash, don't ever buy. But the reality of what I'm saying is we need to buy houses. It is
Yeah.
a great thing to buy a house. It could be the best thing we ever do. But there's a but, okay? And based on my 2 decades of experience and my own nightmares, right now is an extreme time of caution. So I love the fact that, even though House Hacker and I may be a little bit different in our views, we could still talk. And that's why, like, when someone had that comment, Crash Bros versus Cheerleaders, I think we can all gain from that, from all of that perspective. But not everyone has the composure of House Hacker and I, right? Where maybe we butt heads a little bit, but then we started talking, and now it's just like, man, I'm happy that his story, and we can use his story to help people purchasing the primary residence, because I'm not worried about House Hacker. He knows how to buy real estate. I'm worried about all of the other people that don't know how to buy real estate, which is most people. So when I'm talking to the viewers, I'm not talking to House Hacker. You see? Even though he's watching and I am, but I'm not talking to you, House Hacker. I'm talking about all of the other people that are not like you. So I think people get offended by what I say sometimes because they feel like I'm attacking them, but some people I am attacking specifically by name. Like yesterday, I shouldn't have done that. Anyways. But here's some really good stuff. Um, okay, this is from House Hacker as well. I'm looking to cash out, refinance, and turn my VA to conventionals. See, this is exactly, yes.
Yeah.
I
Same
called
thing.
it. I call it. I
Yep.
called it. I'm so proud of myself, Jennifer. I've been out of the origination game for a year and a half, 2 years. So it's hard to remember this stuff when you're not actively using it. So yeah, exactly. So he may convert his VA to conventional because he wants to get potentially cash out, but he's saying that he's not going to recklessly do it either because probably House Hacker has enough sense to understand that just refinancing a loan can be a bad thing, right? Because you're
Yeah.
starting it over again.
Right.
Your loan's bigger. If he has a 4.3 now, his rate will probably go to 7.7. So you got to make sure there's a benefit.
Right.
Appreciate you, House Hacker. I'm really glad that you're talking, brother. Thank you for being a viewer, and thank you for helping our community learn how to buy real estate. Okay, here's Jason. Help me understand. Oh, this is a good one. We got to know everything as loan officers, Jennifer. Do you ever feel that way?
Yes.
My God, right?
And I
Yeah,
can do everything. That
all
is
the
for
time.
sure.
I tell everyone all the time, it's like loan officers have to have every answer because there's so many unique situations. Okay, help them understand, and I can't break this down very well, but a trust shields you from taxes when passing on a home from a family member to a family member, so you don't have to pay capital gains. Is that a thing? So if someone has a home where, well, then if they sell the house, then there wouldn't be a trust of your families, right? Like
Yeah,
the
right.
whole trust would have to agree to sell, and therefore it wouldn't be an issue. There would be no capital. Oh, but if the sale starts out in a trust, is there capital gains? I don't know the answers to that.
I don't know the answers to that either. I would think it follows the same rules as the capital gains, not being on your primary and all that kind of stuff. But I
Mhm.
do know, and I actually just did this. We finished our, and this is something we should talk about at some point too. When you guys own houses and do things like that, you need to make sure that you have a will. You need to make sure
Oh,
that you have all of that stuff taken care of for when, if something were to happen to you. And the trust is what kind of just reminded me of that. Last year, we actually did that. My husband and I finished all of our stuff in terms of the estate planning. And we actually did put our houses in a trust. But I will tell you that the reasons and all of that stuff that the attorneys, I mean, my financial people gave me and everything, and the attorneys is so convoluted to me. I know it's
yeah.
beneficial to do it, but I don't understand how it impacts all of it. I just know that it makes it easier for if the two of us were to die, because it's in a trust, it makes it easier for my kids to handle that property through that process. I don't know about the capital gains part of it, but I just know that having it in a trust makes it easier for them to do what they've got to do once we're gone. So that's all I'll give you on a trust. I would say for sure contact an attorney that can explain it all to you much better than I could.
Yeah, yeah, good, 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 good. All right. I love these questions so much. So his question is when qualifying with non-taxable Social Security income, how much can you gross up the income? And just for the viewers that don't know what he's asking, basically, like any type of fixed income, whether it's Social Security, disability, even child support. Will you go into non-taxable income? And I know depending on the can you go into the tax bracket and then grossing up? Because I'll let you answer it. I want to. I'll let you answer it.
So the answer to the question, it actually depends on the loan you're getting, because different loans allow you to gross it up a different percentage. And I don't know all the percentages off the top of my head. I know that VA is different. But in general, we can gross it up by at least 25% as long as we prove that it is non-taxable. So it depends on the loan type you're getting. And we only
Okay.
do that if we need to, right? If we don't need the income to make the ratios better, we just don't, because it's just easier to go in with the base of your Social Security. But if we need to, then we'll gross it up to 25% in general. But again, it depends on the loan.
Yeah. So depends on loan. And it also depends on the income bracket.
Yes.
Because just because someone's on Social Security doesn't mean they're not making a whole bunch of money elsewhere. So I believe the starting gross up is 25%.
Yeah.
Right? But if
Yes.
they make too much money, it goes down to like 110%. And what that means, guys, is if someone's on Social Security or a non-taxable income, and we can show the 3 years of continuance, they are allowed to use 20. For the sake of argument, most people are allowed to use an additional 25% of that income to be used to qualify for the loan. So what is their DTI really? You know what I mean? Like their
Yeah.
DTI, when we don't do that, it's 25%,
Excuse me.
based on, there's a calculation to use, but generally it's 125%. It also depends on the loan. Like she said, it also depends on the income bracket. Very good stuff here. Very great questions. You guys are answering very great questions. Good one. Do you want to talk to her about, and I know I have my credit class. They don't know what I do, Jennifer. They don't know. My viewers don't know. I've made a credit class for the state of Texas on how credit works. But can you answer this? How hard is the hit to your credit score when you let someone check your credit for a loan?
What I've always been told, and what our credit repair company has always told me, is it's like 5 or 6 points to your score when you get a mortgage check. So it changes it a little bit, but not, it's in most cases, it's not going to put you from qualifying to not qualifying, right? Because it's such a small hit. That's what I've been told.
Okay. Yeah, I mean, it's going to be a hard hit. I was told, 5 to 7 points is what I was told.
Yep.
Well worth it if you
Oh, yeah.
have no idea what's going on in your financial situation. But definitely, in my opinion, you shouldn't be going to like internet lenders. You need to be going to lenders that actually put a tremendous amount of due diligence in, because Kim, they could really plan things. Well, I have to be careful saying this, but they can really provide you a blueprint on what you need to do next and what you currently qualify for.
Right. It's best to know where you're at before you figure out where you're going.
Yeah.
And doing the credit check, even though it's 5 or 6 points, I always tell my buyers, who cares, right? We need to see where you are, especially if you have a plan for your time. If it's going to be 6 months from now, let's see where you are now to make sure you're going to be ready in 6 months, because you just don't know what's going to be on there.
And as a loan officer, will you please tell the viewers the difference between good credit and okay credit?
So in terms of what you get, is that what you mean? Like, what you, in terms of what you're
Girl,
offering?
hey, I got the same question as you. You know what I mean?
I think
we got to
that's
do a
what you mean.
little bit of assuming. I would say as far as like overall purchasing power.
Yeah, I think so. What's real important to remember is that when we do an analysis for someone for a purchase, think about it like a wheel. How many spokes of the wheel? 5, 6, 7, 8, 10, however many spokes there are of that wheel. We look at every spoke and see what the level of risk is for each one of those spokes, right? So having the highest credit you can, having the best credit you can, strengthens that part of your application. So it can forgive maybe something that might be weaker on the other side. Maybe your debt to income ratio is a little higher, but your credit's really good, or you have great job history, or you have a lot of money in the bank as reserves. All of that stuff is taken into consideration on a loan application. So in general terms, the higher the credit, the more obvious it will be that you're going to get approved for a loan, right? Where if you have weaker credit or mediocre credit, or something less than great credit, that's a weakness, or could be a weakness. So we want to make sure that it's not so weak that all the other things on your file don't strengthen enough to get you an approval. I hope that makes sense.
Yeah.
In terms of the impact it could be on your loan, it could impact your interest rate. It will certainly impact your monthly PMI if you're going conventionally, because PMI on a conventional loan, which is that extra payment you have to make, is based on your credit score. So the lower that credit score is, the higher that PMI is going to be, the more it's going to cost you every month. So, in terms of that type of loan, I would say, the high score is obviously the best way you can go. On FHA, they don't care what your score is. The PMI is the same for everyone. So it depends on what kind of loan. That's where we get into the, the real deep stuff. Is it depends on the kind of loan. It depends on everything, which is why most of my answers to most people are, it just depends, because every situation is different. But I would say your goal is always to have the best credit you can, because that's going to be the pillar of your application is the strength of that. And that counts for a lot.
All right. Now let's see here. So I'm just going to say this. It makes a huge difference. But let me change good credit with great credit. The difference between great credit and mediocre credit, in my opinion, it depends on the loan, but overall it is a vast difference. If you have great credit, you can pretty much get qualified for almost any loan.
Yeah.
But also there's LTV and DTI criteria, but just based on credit alone, you're going to have a lot more options to do even creative financing. You're going to get lower interest rates. You're going to pay less fees. And I think there's a lot of misconception about this new credit tax. Like people are like, oh, I should have bad credit. Like, no, all that did is it just made it more expensive for good credit and less expensive if you have bad credit. It's still way worse. It's still way worse. It's not, you know what I mean with it. So I would say, especially if you're on the sideline right now, Don, you should be, well, I can't give personalized advice, but we should be, if I was on the sideline, I'm on the side. I'm doing everything I can to increase my FICO score. In fact, I just had a Credit Karma update. Do you want to see my credit scores? Hold on. I'm so proud of my credit score, Jennifer, because I had a bankruptcy, repo, foreclosure, and all these things. And it took you know what I mean, it took a minute to get here again. It
Oh
was
yeah,
so
sure.
hard. It was so hard. I had that bankruptcy, all right, take a look. Here's my credit score right here. You guys see that? Can you see it?
It's not focusing.
Okay. All right, well, I got a Geico commercial. Boom. Can you see it?
Nope.
816 and 818.
Wow.
I'm so proud of myself. My score is better than my wife's.
That's like that. That's incredible.
Thank you.
That's
Thank you.
totally incredible.
It's better than my wife's. My wife's like, how do you have credit? Like, you used to have, like, da, da, da. It's like, because I'm winning. It makes a big difference. It was a complete hell when my credit was taken away from me. I mean, it was so depressing, Jennifer. All right, now here's a comment. I'm not sure if this is real. Buy now, or once rates go down, be ready to pay 10% more for home prices. So, all right. I'm going to be nice. So that's the bullish thing, right? If you don't buy now, the Fed's going to pivot and they're going to lower rates. And what I'm so desperately trying to explain to people, Jennifer, is the Fed's going to lower rates when things are broken and unemployment is out of control, at least in my opinion. And when unemployment's out of control, ain't no one going to buy. This happens all the time. And the thing is, Jennifer, because I didn't go through the 70s and 80s when we had the inflation, I went through the great financial collapse. This is different. This is a federally induced situation. It's an inflation fight. So I had to go back and I talked to my wife's parents last night at dinner, and I was like, do y'all remember what it was like in the 70s and 80s? They ended up getting a bankruptcy. You want to know why? They own too much real estate. No joke. They own so much real estate, and when the market turned in the 70s and 80s, they lost everything. So I was like, because I wasn't in the 70s days, it's like, did y'all remember how the house market was? And like, yeah, the house market was messed up. People were boarding up houses. There was foreclosures. Rates were double digits. No one can afford things. So that's what we're going through now. And I think the reality is, Jennifer, and I'm not sure, and I don't want to scare you, but I think I think it's going to be this month. I think we're going to hit 8s. I wouldn't be surprised 9. And the reason is well, all said and done, the government needs money to survive the debt ceiling deal. Mm-hmm. There's a crowding out effect. Most of the deposits from banks are in the reverse repo market. Odds are that all of the yields are going to go up, including the 10-year. And there's some people that think the 10-year treasury, I don't know, I'm not saying this, but there's some people that I've heard say that the 10-year treasury can get to 6% within the next 2 years. And I don't know if that's possible. I guess anything is possible. It's just so hard to imagine 6%. But I'm pretty sure interest rates are going to go up. And when that happens, it's just so bad right now. I'll shut up. I'll shut up. This is just a Q&A. I don't want to. All right. So here we go. Okay. Here's one from Lola. So here's some personalized advice for me. Okay, Jennifer, tell me if you agree with her. I'm always trying to improve myself, but she's like, I definitely have a disorder. I really enjoy your authentic style, but just relax and enjoy the moment. Well, I'm enjoying it now and I'm relaxing. Great advice. Lola, thank you. I'm relaxed. Lola, I can't get relaxed. I lost everything and I don't want you to lose everything. When there's a tornado coming, you don't whisper like, hey, is that a tornado coming? I'm going to get up and I'm going to dance around with you guys. But I get it, Lola. I try to take every comment. I try to take even, as long as it's not like hate or racial stuff, I try to take every comment, with like, what's the good in it? But sometimes they blindside me and I just wasn't prepared for something that I read. I'm pretty sure that there's people making troll accounts like other YouTubers, Jennifer, because some of these comments, there's like only a content creator would know to say something like that. I know there's trolls out there.
I'm so glad I can't see the comments.
No, these are all good.
Okay.
Okay. And we're about to be done. We were an hour and 45 minutes. Let me just see if there's any, let me throw up house hackers real quick. I'm just going to leave that up here. My question is, whoa, this is good. This is good. This is good. Okay. I'm going to leave this up here, guys. And I think I'm at the bottom. Good. Oh, again with Steve. Steve, I'm going to call Steve. Actually, I need to call Steve, but I like this. I like what Dusty's saying here. First of all, I have a lot of questions. So to me, there's way more, but this is a good point. There's a point he's making. The only question is what would cause more inventory? No, no one will sell if rates continue to climb and prices fall. Psych, divorce, health issues, job relocation, job loss. So
Yep.
that's not true. But there is a merit of truth there because there is a substantial amount of people that will not sell because of those high prices. And we're seeing that with the listings, actually. So there is merit here. There's merit to actually both what we're both saying. Um, Rates will continue. Okay. Well, no one will sell if rates continue to climb and prices fall. Also, no one is building right now with high rates. I'm not sure.
Yeah, I'm not sure what he means there because
I'm not
there's
sure.
building all over the place here.
He must not be in Texas. I have probably 7 new developments around my house, like in a 10-mile radius of my house.
Yeah.
There is so much. Maybe they're saying like building a house, because I thought about that, like buying a lot and then
And
building a
building
house.
stuff. Yeah.
I think that could be a good idea. So I don't know if he's talking about that, but I would say that he may be right with that. I don't see a lot of people building houses for like personal private houses, like
Yeah.
builders. The amount of units under construction is historical when we count multifamily.
Mhm.
It's historic. It's never. We've almost actually. I think a couple months it was higher, but the amount of homes actually under construction, despite this comment, unless he's talking about private, is actually the opposite of what he's saying. It's historical. Again, when we add multifamily is historical. SFR is slightly lower than 2008. But as far as the inventory comment, I mean, the guy's spot on. Now we have in certain metro areas, I believe, hyper supply or inventory with new builds. The new building has inventory. We do not have inventory like we need at all, actually, in the resale, right?
Right.
So a lot of things going on, but I definitely appreciate the comment, Dusty. You have a solid point, brother. Not only do we need inventory, we're probably going to need some forced selling as well on top of that. So I'm cash flowing as primary and rental home. I'm a retiring in military, and I work in healthcare, which is in demand in civilian jobs. So, House Hacker, did you go to Pendleton? Let me know if you went to Camp Pendleton. I've been to Coronado shark fishing. I've been all over San Diego, man. I have a bunch of friends in Camp Pendleton, bunch of Marines. They're the only guys that keep up with me because of all the stuff I do shark fishing. And they snuck me on the base. Maybe I shouldn't say that. But I was like freaked out, Jennifer. They're like, say you're a grunion hunting scientist. I was like, what? To a government official? They're like, yeah. I'm like, I don't know if I should do that, right? I was all scared. But they're a bunch of Marines. I just love those guys. Love those guys, man. All right. Other than that, I'm going to end it. Do you have anything you want to say, Jennifer, before we go?
What I'd like to say is I love seeing all these repeat names. I'm recognizing a lot of these names from the couple times we've done this. So I love that everybody's watching and seeking out good information, because my whole deal is education. I want to make sure that people know what they're doing, make sure they, like, and I forget who said it before, but go into it knowing what you're doing. Have a plan. Don't just blindly go into buying a house or blindly go into anything that you're doing. So if we can help in that education process, that's what it's all about for me. And so I really appreciate, all these people being on here. I appreciate all the questions and the opportunity, Travis, for being on here. So thank you.
Can I ask you, Jennifer, do you think by having that attitude, it makes you less money?
I don't think so. I would hope not, because
I
I
say
a place of giving versus getting,
I say that because you and I know that there are loan officers out there lying through their teeth,
Yeah.
especially about costs, that they're just going to say, they're just going to do whatever, and they're going to cut corners. They're going to bait and switch. That's why I say that. So the reality is, I'm going to be honest. I mean, you're going to lose some customers by being honest and cautious.
Yeah.
Like there are customers, guys, that they fight us. Like we're the experts. Like we know all these things, right? And still people fight us on this. So, it is what it is. You're getting a lot of love. I really appreciate it. Oh, wait. Whoa. Jason, what was your question? I think he's got one more question. He's lucky I saw that in my peripheral vision. Is that a thing? Yeah, that's the thing. Peripheral vision. Because I
Peripheral.
always peripheral.
Yeah.
Let me see real quick. So we'll just answer this last question. Where's Jason?
It looks like
Jason,
he's
throw your question
pointing.
up. Huh?
It looks like he's pointing with an arrow, like someone had a
Oh,
good
here it
question.
is. Okay, this is it. His question is from. Oh, he's a Marine as well. Um, Love him. All right. Say his wife has an 800 credit score and he has a low 700. Let's say he has a low 600 credit score because they don't know that there's tier 720, 740, 760, 780. We won't go there. LLPA adjustments. 800 plus score versus a high 600. Okay.
Okay.
In a VA home, whose credit is used? Are they both considered? He's the veteran. Ooh.
Can I
Go
answer
ahead.
that?
Mm-hmm.
Okay, so as the veteran, you're technically considered the primary because you're the veteran. So we put the loan in your name first and then your spouse's name second. However, it does not matter on credit score. So if your wife is also on the loan with you, and this is true for any loan, not just VA loans, every single loan we do goes by the higher risk. So if you have the lower credit score and you are on the loan, everything is based off of your credit score.
Correct. So, having said that, well, in this case, he's a veteran. You're stuck. But listen to me on this one. This is really good stuff, guys. Like what Jennifer and I do sometimes. Like if it's a conventional USDA, FHA, and we have a husband and a wife. Okay, say the husband has a 700 credit score, but the wife has a 500 credit score. And if they're both on the loan, what Jennifer's saying, if both those people are on the loan, we have to use the lower credit score to qualify. Listen, we have to use the lower credit score to qualify.
Yep.
The trick is if someone has a low credit score, remove them from the loan so long as you don't need their income. So long as the person with the better credit score can qualify on their own with just their income, you can use the higher credit score. But if you need the income from both husband and wife, you're at the mercy of the lower credit score.
Right. And
So,
in Jason's case, we have to have him on the loan because he's the one with the veteran benefits. So she
yeah.
can't be on a VA loan on her own. So in his case, he'd have to be on the loan. So we have to go off of that. But I will also tell you at the same time that having a co-borrower with a higher score strengthens the file, right? It kind of
Mm-hmm.
evens it out a little bit because we have someone who's got, maybe great history or great scores or whatever the case is, adding strength to someone who may have a little bit weaker scores. So, it kind of evens itself out a little bit. But in your case, Jason, you have to be on the loan because you're the veteran. It's your benefit. But if we were doing conventional or something else, we could take the other person off again if they could qualify without the income, which is the biggest question. We don't always know that.
All right. I love it. I love it. I mean, this is gold here. I know we're talking like Martian language, but some of
Yeah.
these questions they're so important to ask. There's so much preconceived notions out there. But anyways, Jennifer, sit tight with me, okay? I'm going to end the broadcast, all right? You guys, if you're out there investing in real estate, you know that both Jennifer and I wish you luck, and we both, and I don't want to speak on your behalf, hope that you win.